Hello ladies and gentlemen, in today's video I'm basically going to be explaining every draw liquidity in their hierarchy from A plus to basically the worst type of draw liquidity. I'm going to be showing how to take trades targeting good draws and liquidity, because the most important thing again in that checklist is draw and liquidity is the number one thing we must be looking for while we take a trade. Alright, so we're going to get started here. The first draw liquidity I'm going to be talking about is LRLR. This stands for low resistance liquidity runs, which is basically just LRL, low resistance liquidity. And you can find this in the market when we have a trend line formation of highs or lows that are being stacked in the market, such as right here. So this is a good example of LRLR. Here we have 1, 2, 3, 4 touches on the trend line, which is very clean, right? And the way you want to be able to be trading LRLR is a manipulation to the opposite side. So something like this, and then to see an inversion for a value gap here, to then target to run these lows. So in this example, we don't really get an inversion setup, but what we do is manipulate to the upside first. Right, we take out these highs right here. You can see how we take out these highs on the 5 minute. If we go to the 1 minute, we can see this a little bit better, a little bit more clear. You can see how we have the trend on liquidity all stacked up here. Price at 9:30 open manipulates, takes out this high, and holds this fair value gap to the left, right here. And when we do that, we can see that the fair value gap gets respected, and then this is where you'd be looking for an inversion, right? In this example, there's no inversion. Maybe actually on the 15 second, we do have a pretty textbook inversion here. So it does go invalid, unfortunately, but you kind of get the premise here. You're looking for an inversion here to run these lows, because this is a very good liquidity point in the market, and price likes to run all of this. And you can see we take out all these lows. So that's the first draw liquidity I'm going to be talking over. The second draw liquidity is the data high, data low. So primarily 8:30 to 10 a.m. news on that red folder. If we go to forexfactory.com, you can see that we get red folder news. I'll go back here because we have a government shutdown, but at 8:30 we usually get red folder news. The main ones you want to be looking for: NFP, PPI, CPI, FOMC. Those are really heavy news events. Even unemployment claims can give some data wicks sometimes. But at 8:30 or 10 a.m. usually, sometimes FOMC, which will be 2 p.m., you'll be able to find these data wicks, which are made off the candle's volatility. So when the news gets released at the 10 a.m. or 8:30 candle, you'll see a spike in volatility. So here we get a data high and we get a data low. So the way you want to trade this is you want to wait for one side of the data high or data low to get taken. So here we get the data low taken. You want to see price manipulate into some type of scenario where you're getting pretty quality setup, and A plus setup would be what I'd be looking for. Here we sweep at a low inside of a fair value gap, and now I'd be wanting to target the data high, which is right here, right, which was came off 10 a.m. news. So I'll be looking for an inversion here, right? So if I go to the 2 minute, I find my inversion. Okay, I'm in there, right? So if I take this inversion right here, stop about here, target that data high, I can get a very, very clean 1.19 RR trade. I can even hold runners for these stacked highs up here, right? So this is a very good draw on liquidity in the market, and you can see price runs all of that really, really efficiently and well. So yeah, this is a good draw on liquidity in the market. A plus draw on liquidity, one of the best in the market. Actually is the best in the market in my opinion. So yeah, 8:30 and 10 a.m. news, tendency to have data highs, data lows. Make sure to look for these. Now that doesn't mean you can take some like crappy setup, still wait for a decent setup to them. Like in this case, we had an A plus setup, manipulation leg, V shape up. This is very, very high quality, and you should 100% be taking something like this. So we'll get into the next draw liquidity. The next A plus draw liquidity, a top tier draw liquidity, are equal highs and equal lows. So I'm basically just going to draw this out. When price makes equal highs in the market that are at an exact point and are spread out, right? The hierarchy for equal highs to make them, to basically say, are they good equal highs? Because some equal highs are bad. Bad equal highs are highs in the market that are like right next to each other, right? If you have like equal highs that are right next to each other, for example, let's say let's say right here, this wick on these highs, let's say these were equal highs right here, just these two. If these were equal highs, these would be bad equal highs because they're not really at a swing point, they're not really prominent, they're not obvious, and they're not spread out. So what you want to be using for equal highs, so equal highs kind of hierarchy slash lows, right? You want them to be spread out. If they're triple or more, that's really, really good, right? If these are triple equal highs or more, that's a very good draw on liquidity. And on multiple time frames, right? On multiple time frames. What I mean by that, if you see the equal highs on the 1 minute, 2 minute, 3 minute, 5 minute, etc., that just keeps increasing the rating of the equal highs and making them a better draw on liquidity, right? If we look at these equal highs right here, so this is at a swing point, but this is not at a swing point, so I would not care about these equal highs. Now, if this equal high was made off this swing point, right, because this is that swing high, and we made equal highs up to here, then I would care about it, right? So that's very important, is to make sure that equal highs are at swing points and are spread out, right? So that's the hierarchy of equal highs, right? If you want to be looking for good equal highs and good equal lows to target, spread out, triple or more, multiple time frames. Yeah. Now, another different thing that a lot of people don't talk about with equal highs are equal highs on fair value gaps. So, for example, and equal lows. So here, let's say price came down, right? Where the fair value gap starts, right? If you think about a fair value gap, if this is our fair value gap, right? And it starts here, meaning if price is going to tap into this fair value gap, the fair value gap starts here because you start here and then it taps into it. The lower we go, the more you dig into the fair value gap, right? So if price comes around, spread out, and makes equal lows, right? Or I'll show you a bearish example. Right? If we make equal lows with this wick, this bottom wick, that is significant in the market, and you should be paying attention to that. Another thing, right? So that's like the long, the bullish for value gap example. For a bearish for value gap, it's the same thing. So if we come down to a bearish for value gap, and we go to the start of it, right? So if we go like here, right? The start of this bearish for value gap is right here, right? So price comes into it. This is the start of the bearish for value gap. And again, the more that you go into it, the more you dig into it. So this would be the start. You take this wick, right? This wick's high. If we now get spread out equal highs, right? If price comes up, makes an equal high with it, like the wicks like that, makes an equal high. Then these are also significant in the market. So make sure to pay attention to that. So yeah, that's equal highs and equal lows. So those are the top 3 draws on liquidity. Other draws on liquidity that are like decent in the market are like intermediate term highs, like basically a high inside of fair value gap. Like this is a good draw on liquidity. High, like as this is a high inside of fair value gap. So once price starts that buy model, right, that buy side of the curve, right, when we start that buy side of the curve, you can be using these highs in these fair value gaps as take profits. They're not A+ draws on liquidity because they're not like data highs where you're kind of like really looking at them. But these draws on liquidities are decent when you're trying to just take simple targets, right? Off like a long, maybe you're getting a reversal or something. Yeah, same thing with like lows inside of fair value gaps, right? If we take a low in a fair value gap, something like this, you can see this is a low in a fair value gap. Price wants to run that, takes that out, right? Maybe get a long off of that. So another good draw on liquidity are lows and highs inside of fair value gaps. So like right here and high inside of fair value gap right here. Now let's talk about some bad draws on liquidity. This is more important than good draws on liquidity in my opinion, because if you're taking setups, right, that are targeting draw on liquidity that is bad. Remember, draw on liquidity is our #1 priority when we are looking for a setup. You do not want to be targeting draws on liquidity that are high resistant. And what do I mean by that? I mean protected highs or just high resistant highs in general. A protected high is a high that sweeps out another high inside of a fair value gap. For example, you see how this high right here, this high right here is inside of what? This high is inside of this fair value gap, right? If price now were to come sweep this high, right? If we came and swept this high, something like this, we swept the high, we swept this high and we respected this fair value gap. Let's say we respected that fair value gap. Now this high is protected. This is a bad target in the market. You do not want to be targeting this until we take some sort of major sell side liquidity. So now let's say we take that high out and then we come back down, and then let's say we have like some lows here, and price basically comes down, sweeps out lows. Some major, some like obvious low that we take out. Now I can target this high, right, if it follows my bias. So you do not want to be targeting highs and lows that sweep out other highs and lows inside of a fair value gap. Here's another example. Let's see. So a low inside of a fair value gap, right? Something like this. Here, this is not, you see how price sweeps out this low? So price sweeps out this low inside of this fair value gap. This is not really a good target here. Now it does come down and re-sweep the low, but in general, you do not want to be targeting lows or highs that sweep out other lows or highs inside of the fair value gap. Now it's very important to make sure that the fair value gap gets respected when we take out that low. If we close below the fair value gap, then it's not a protected low. But because we waked up and we respected this bullish fair value gap, now this low becomes a lot more high resistant and more protected. Right? So you must try to target low resistant highs. Think about like orders, right? If there's multiple orders sitting below this this low, right? That's our liquidity. Why would I want to be targeting a low that just took a bunch of orders and rejected, right? That means there's not going to be a lot of orders here. Where there's going to be a lot of orders are lows and highs that have not been taken out, right? Remember, if we think back to that LRLR example, right? These lows have not been taken out by the market yet. So there's a lot of liquidity below each of these lows, right? Each of these lows are stacked points of orders, and that's why price wants to run them with volatility, with a lot of volume and a lot of movement, right? It's quick displacement. These high resistant highs and high resistant lows are not good targets in the market, and you want to be avoiding them. So yeah, that's basically going to wrap it up. Actually, I'm going to explain one more thing. The last round liquidity are unmitigated gaps, so unbalanced fair value gaps. They're decent. They're not A+ at all, because we can definitely leave some certain fair value gaps. But right, if price is in a downtrend, right, we need to rebalance. You're not just going to dump and dump and dump without some sort of rebalance. So even off this news event, right, we had that Trump news on Friday. You can still see what do we do? We rebalance right here. We rebalance this 5-minute off that wick, and we come back up here, rebalance this 5-minute, right? So even if, like, let's say for example here, let's say we're sweeping out some major low to the left, right, and we're tapping to a higher time frame PD array. If the bias is still bearish, but you understand that okay, price must rebalance, then you can maybe take some type of lower time frame long here, and you can target an unmitigated gap for like a 1 hour base hit, right? So here price rebalances and then keeps on selling off, right? Rebalances, sells off. So you can still catch like trades like that, even if it's against the trend, if you understand price needs to rebalance here. And this strong liquidity is not A+, it's not nearly as good as a data high or data low, or like equal highs or LRLR, but still a decent strong liquidity in the market. Okay, so that's going to wrap up this video. Please like and subscribe, and leave any comments if you need me to go over anything else or any questions that you guys have.